What return on capital actually means. Most people think they understand return on capital. They can write the formula, they can calculate it, they can even compare two companies using it. And yet, most people completely misunderstand what return on invested capital is actually telling them. That's because return on invested capital, or ROIC in short, is not a formula first concept. It's an economic idea. If you approach return on invested capital as a number you compute, you'll misuse it. If you approach it as a way of thinking about the underlying economics of the business, it becomes one of the most powerful lenses you can use. So in this session, we will do something very deliberate. We will not start with a formula, but instead, we will start with what the capital really means. And only then you'll understand what return on capital is trying to capture. Let me explain what return on capital actually means in 6 steps. So step 1, let's see what do we really mean by capital. When most students hear the word capital, they think of money, cash, funds raised, or some technically advanced students, they might think of capital as equity and debt on the balance sheet. This is already the first mistake. Capital is not the money sitting idle. Capital is economic resources that have been committed, locked in, and put to work in a business. So once capital enters a business, it loses flexibility. You can't easily pull it out. You can't redeploy it without cost. You can't reverse decisions clearly. Factories, brands, software, distribution networks, trained employees, supplier relationships. These are all forms of capital, whether accounting rules recognizes them as capital or not. So capital is not about where the money came from. Actually, capital is about what the business has tied itself to in order to operate. That's why balance sheets are incomplete representations of capital, but we'll come back to that a little later. Now, step 2. What do we mean by return? Now, let's look at the other half of the phrase. Return is also misunderstood. Return is not net profit, EPS, profit after tax, cash at the bank, or the likes of that. Return in the context of ROIC is operating profit generated after providing for the expenses to run the business. Now, that distinction matters. A business must first pay its employees, obviously, maintain its assets, keep the systems running, protect its competitive position, and only after maintaining itself does a business generate a surplus. ROIC is concerned with that surplus, not with accounting profits that fluctuate due to financing, taxes, or one-time effects. That's why ROIC focuses on operating performance, not shareholder level outcomes. Step 3. Put the two ideas together. Now we can finally say what return on capital actually means. ROIC is a measure of how efficiently a business converts long-term committed economic resources into sustainable operating surplus. It answers a very, very specific question. For every unit of capital this business has tied up, how much operating value does it generate? Notice what ROIC does not ask. It does not ask how big the business is. It also does not ask how fast the revenue is growing. It does not even ask whether the profits look impressive. ROIC simply asks, is this business good at turning commitment into outcomes? Now, that's a very different question. Don't you agree? Now, step 4. Finally, we'll see why ROIC is not a performance. Now, this is a critical point. ROIC is often treated like a score, a ranking tool, or a pass or a fail test. Now, that's a misuse. ROIC is a diagnostic lens, not a grade. A high ROIC does not automatically mean the business is safe, the business can grow, or the business will remain competitive. And a low ROIC does not automatically mean the business is bad, management is inefficient, or capital is being wasted. ROIC simply tells you how hard the existing capital is working today. Nothing more, nothing less. The danger begins when people stop asking why the ROIC is what it is. Why capital is the harder side of ROIC? Most people obsess over the numerator, profit. The real complexity lies in the denominator, capital. Now, capital is accumulated over time, is distorted by accounting conventions, ignores internally created assets. Now, we'll be exploring a lot in later videos about this particular topic. It also reflects historical decisions, not the current reality. This means ROIC is always a blend of economics and accounting, never pure truth. And that is why ROIC must be interpreted, not blindly trusted. Understanding ROIC requires understanding of how capital entered the business, when it was deployed, what form it took, and what the business had to give up to deploy it. Without that context, ROIC becomes a dangerous oversimplification. Now, the final step, step 6. If you remember only one thing from this capsule, remember this. ROIC is not just about profitability. ROIC is also about capital discipline. It tells you whether a business respects capital or abuses it, whether growth creates value or destroys it, whether success is being earned or merely appearing in the numbers. Before you compare ROIC across companies, before you celebrate high ROIC, or before you dismiss low ROIC, you must first understand what capital really means, what return really represents, and what the business had to commit to exist at all. Only then ROIC becomes meaningful.